Welcome to another episode on the Zenith Retirement Channel. I'm Robert Martin. I'm a chartered financial consultant and a certified tax specialist here at Zenith Retirement, where we do retirement plan specifically for retirees. Now, you've likely found this video because you're either a client or you're searching for education or you're thinking about joining Zenith, and you're curious about excess Medicare premiums. You're curious about how your Medicare, the costs you pay in retirement for Medicare, could actually go up and how it goes up. Well, we're going to talk about that today, specifically if you're a higher earner and you make more than $182,000 between both you and your spouse, how your Medicare premiums could actually go up and make you pay drastically more in retirement than you ever thought you would. So let's get started. Before, however, we consider excess Medicare premiums, we need to have an understanding of what Medicare is. So Medicare is health coverage. In fact, you've been paying for Medicare your entire working career in the form of taxes that were deducted when tax time came or throughout the year if you withheld your taxes. Now, there are several parts to Medicare. Medicare Part A provides inpatient hospital coverage. Part B provides outpatient and medical coverage. And then Part D provides prescription drug coverage. And then, of course, C, the reason I left C out is because C is a little bit different, gives you an alternative way to receive your Medicare benefits. So Medicare Part A, you've been paying for your entire life. In retirement, you do have to pay for Part B, which again is outpatient medical coverage, and you have to pay for Part D, which provides prescription drug coverage. So imagine you're retired now, and at 65, you're eligible for Medicare. You paid for Part A your entire life, don't have to pay for it, but you have a fixed Part B and a variable Part D depending on your drug plan. Now, the challenge here is Part B and D actually go up as your income go up. What do I mean? Well, let's say that your income was $182,000 or less in retirement between both you and your spouse. This is an example for a married couple who's filing jointly. Well, if your income is less than $182,000, your Part B is going to remain exactly as it was intended to be, the standard amount of about $2,000 a year, and your Part D is whatever the plan premium is. Now, that's per person. So if you're married and you're beneath this income level, then you're looking at about $4,000 a year in costs for Part B. Now, this is when things get a little different. If your income was higher than $182,000 and you fell within this range on the screen, then your Part B would increase by about $850 per person per year, and your plan premium for Part D would increase $150 per person. So quickly, it can get expensive. It can cost thousands of dollars extra if your income is above this mark. But this is only level 2 of 6 different levels or thresholds that apply. So let's go to the highest one. If you made more than $340,000 as a married couple, your Part B would actually increase by about $5,000 per person every year. Your Part D would increase by, your plan premium, that standard amount, plus almost $900 extra per person. So altogether, you're looking at about $15,000 per year in healthcare costs for Part B and D. That is the impact that having high income can have in retirement and how you could be paying extra Medicare premiums because your income's too high. Now, the challenge here is that if you don't have an income plan, if you're not documenting and planning how you intend to take income, number one, you could unintentionally be creating additional taxes for yourself, which comes in the form of those excess Medicare premiums. Or this could be a threat or a real fact for you, and there's nothing you can do about it, and you have to pay. If that's the case, then there are strategies besides income planning that could apply to actually reduce your excess Medicare premiums in retirement and save you thousands and thousands of dollars. That's not the only thing that applies. This doesn't stay fixed. For example, if you passed a threshold 1 year and you're retired, it doesn't stay like that the rest of your retirement. In fact, it's recalculated every single year. Let me tell you what I mean. let's say in 2020, your income was above that limit of $182,000. So let's just say you're in a first tier. Well, that isn't going to impact you immediately. There's a lag. So if you passed that threshold in 2020, in 2022, your Medicare premiums would go up. And it continues on every year thereafter, exactly the same. So let's say the very next year, 1 year after 2020 and 2021, your income is different. Well, that's going to impact what kind of Medicare you're going to be paying in 2023. This requires proactive and annual supervision of where do you fall with your income. And the solution here really is to watch your income and to have a written income plan to see, A, can you strategize to use different kinds of money you have to not push yourself into that higher Medicare bracket? Or two, having an income plan just to know where you're at, to know that it's not a future for you where you're not paying some kind of excess Medicare premium. And then you know where you stand and you know how to strategize in other ways to reduce your excess Medicare premiums. It's extremely important now in retirement to understand that things were very simple when you were working. And now that you're on the road to creating an amazing life of significance in this second active years, that you have different threats, different costs that are going to apply that you have to be mindful of, that your investment consultant needs to be mindful of, that your team needs to be mindful of, that your spouse needs to be mindful of. In retirement, it's extremely important that you have the right team, that you have the investment guy, that you have the tax guy. And I hope that by watching this video, you realize that Medicare planning is also extremely important, not just in choosing the right plan for yourself, but in reducing the costs, the things that are taken away from you in retirement that could be used to fund a well-planned and lived life. Having a plan to reduce those costs, having a plan to reduce your excess Medicare premiums, and therefore having a Medicare specialist on your team is extremely important. And only when you have all the parts of the plan, all the specialists there for you, can you truly feel comfortable and confident that you are planning for everything that could possibly harm you, and you're planning for everything that could be possibly taken advantage of to provide benefit to you. So with that said, it's always a pleasure speaking with you and educating you on these topics. If you liked the video, give us a thumbs up. If you didn't like the video, give us a thumbs down. Regardless, it's a pleasure. If you enjoyed the video, hit that subscribe button so you can get alerted when new videos come out. Or if you want to keep up with Zenith's retirement and what's going on in the business. With that said, take care.